Interest rate cuts are still one of the hottest topics out there, and we're going to give you an update on when the first one may be expected. And it is now time for us to also dive into this brand new flipping tax. And yeah, it is a flipping tax. Let's also get into why building permits are dropping dramatically and how that's going to set us up for housing supply in the future. And lastly, some insights into just how challenging it is out there for developers to bring new product to market.
And just before we get into today's episode, a reminder that if you're trying to navigate this pretty unclear real estate market, you just want to have a conversation about where you're at, where you might want to go, reach out to the Calendly link for all of our YouTube subscribers right below the video here. Book a call with us and let's chat about it.
Okay, so let's start off with rate cuts. Last week, we saw that better than expected inflation print, and that dramatically moved the needle as to when markets are expecting rate cuts. And with that move, they actually priced in one additional rate cut in 2024 relative to just the 1 week before. So now markets are essentially pricing in 3 rate cuts total for 2024, with the first one taking place in April. And we're, I guess, now right into March. So as early as next month, we can expect that cut. And as we all know, this information can change in a heartbeat. But that said, there's currently no forecasting for either 0 rate cuts or any hikes right now. Sure, anything can happen, that can change. But as of today, we are only expecting, or the markets are only expecting to see cuts in this year. Time will tell. But let's look a little bit deeper into the inflation print here, because the core measures of inflation, which do matter more to the Bank of Canada, well, they lowered to 3.4% down from 3.6%. And yes, that is still above the 1 to 3% target range that the BOC wants to see it in. But let's take a look at that same number if you take mortgage interest rate cuts, mortgage interest out of that CPI basket. Well, that pushes it down to 2%. Great. Okay, but you understandably can't just take elements of the basket out and say that everything's fine. But the reason that we're having this conversation, the reason we do look at it with mortgage interest rate taken out, is because if you look to other countries around the world, well, they do not include mortgage interest as part of their CPI basket, part of their inflation data, because it's essentially a self-fulfilling type of scenario, right? Because if rates go up, well, inflation goes up, and then rates go up, and that pushes inflation back up. It's like a dog chasing its tail, essentially. So now there are renewed calls for the mortgage interest element of the CPI basket to be removed from how they measure it. Don't maybe expect that to happen, but it does speak to potentially how flawed our CPI calculation may actually be in this country.
It's just, at times it's comical. I think if you're really going to measure any kind of progress, you can't just change, the goalposts every time you want to measure progress. So, I always found it interesting when central banks massage the CPI basket, just depending on the kind of climate they're in. It's not a very telling or accurate way of forecasting where things are at. What are we really at? Are we at 3%? Are we at 1.5%? Are we at 2%? Where are we? It's very confusing. Moving on to new housing supply here. Housing starts dropped 10% month over month in January and are down 18% since the November highs. We're sitting at around 245,000 new homes on the year, just slightly above the long-term average. But what's worse is expect starts to decline in the coming months as building submissions and permits have fallen to the lowest levels seen back during the COVID lockdowns. They're down 22% nationally. And in Ontario, for example, they're down 39%. Strip out the COVID data points, and new building permits are back to 2016 numbers. It's an 8-year low. Under construction, though, is at an all-time high of 353,000 units. But we may very well be starting the current cycle peak, as the dramatic drop in building permits is kind of telling where things might be going. Expect the under construction numbers to drop through the rest of 2024. We have been seeing this through our own network, and we've been seeing this through our own developers that we've been talking to, along with construction employment. That's likely all but certain to follow.
So let's dive into the new flipping tax that was announced last week. You may have noticed that last week we recorded our episode early on Tuesday, which was, I think, the day before the tax was announced. So we had some time here to kind of go through it and wanted to chat, kind of walk it through really here. And as usual, the government is not looking inwards as to where the housing crisis originates from and where the problems truly are. And so last week they decided to point the finger at home flippers. They're the new cause of our housing crisis. And so this tax, it's a tax of 20% on the gain of a home sold within 1 year, and prorated on sales of up to 2 years. So if you sell between the end of year 1 and year 2, it's kind of a sliding scale downwards to 0. The intention of this tax is to discourage short-term holding of property for profit. What? Like, who does that? People don't go and buy a home and say, okay, I'm going to hold this for 12 months and just, reap the rewards. And I'll get into those numbers in a sec, but it's flawed out of the gate, is my opinion here. And do keep in mind, this flipping tax is in addition to the already in existence federal anti-flipping tax. So there's 2 taxes if you flip now. The federal one is quoted as being the profit from property flipping is fully taxable as business income and does not qualify for the 50% capital gains inclusion rate or the principal residence exemption. Okay, so who is this tax targeting exactly? Because as I mentioned, nobody goes out with the intention of buying a home, holding it for 12 months, and then running away with hundreds of thousands of dollars. Like, if you go to buy and sell a home within 1 year, the costs, the fees, the taxes on that sale and on that purchase within 1 year, it's upwards of 6%. That's the cost to buy and sell a home. So if the market had a good year and went up 6%, you'd be breaking even. But you'd have to go through all the joys of buying and selling a home. Like, it doesn't make any sense here. Like, are you expecting that the market's going to do 12% year over year, so you just make a bit of money? That doesn't seem to make sense here. So then let's talk about the other segment, people who actually buy homes, fix them up to make them more livable, and then sell them for a profit. Okay, they take essentially a derelict home, something that maybe nobody would want to live in, and make it absolutely livable. So is that someone that should really be targeted as the evil person that's causing all of this unaffordability in our country and in our city here? Think of it like this. If you are a home buyer, you're a new home buyer, and you're entry level, you can afford a condominium of $500,000-$600,000, for example. And when you go and you look at what's on the market at $500,000, you're like, wow, these are really beat up. They're really old. The carpets are 40 years old. Maybe I don't want to live there. Okay, that's tough. But then you have somebody who comes into that same property and they put in $50,000-$60,000 and they flip it 6 months later for $600,000. Okay, so they're making just a little bit of profit here, and now you've got a beautiful, livable home. Well, as a home buyer, the difference, the money that you need to come up with to buy a $500,000 house to a $600,000 house, if you qualify at 5% down, you only have to come up with an additional $5,000 to buy that now beautifully renovated home. Okay, and that might be a lot more possible for a home buyer than coming up with the $50,000 to $60,000 to fix the home and to fix the home and to apply for the permits, et cetera, et cetera, et cetera. Okay, but again, these flippers, these people who are making these homes livable, are the devils of the industry. Apparently, this tax does apply to free sales and assignments as well. Again, I think it's flawed because ultimately, if you are looking to actually profit by assigning a contract of your pre-sale, realistically, you got to wait more than 2 years anyway before there's going to be any type of lift there. So you're not going to buy an assignment, flip it in 12 months typically. So no real profit there. How much of the marketplace does this tax apply to? Okay, so again, we're trying to create affordability here. Well, in the last couple of years here, Vancouver and Victoria, homes that are flipped in under 24 months equates to less than 2% of all total transactions. So as usual, this tax is going to have basically zero effect in pricing and affordability. It's yet, in my opinion, another tax thrown out there for the optics of our politicians doing something and buying some votes. And ultimately, it'll likely just hurt the industry. Let's take a quick look back and talk about all the other taxes that they have put in play here. And let's talk about how affordable these have made homes. Okay. Going back to 2016 is when the foreign buyer tax was implemented. And then they increased that foreign buyer tax. And then they made a foreign buyer ban. And then they introduced a speculation tax and then a vacancy tax. And don't forget there's GST on new homes. And then we had PTT, and then they increased the PTT, the property transfer tax. And then they put on all these Airbnb restrictions and saying you can't do it unless it is your primary residence. And then there was the federal flipping tax, and now there's the provincial flipping tax. So here's just a ton of taxation on homes over the last 8 years. And yet, has any of this increased the affordability of our housing? I mean, we're up 14% in the average home price since that original tax back in 2016. On top of this, even with all these new and increased taxes, our province is running at one of the largest deficits we've seen. So when we, look at where all this money is going, it certainly isn't going to building affordable homes, at least not that we can tell. And when we look at Ryan's point about the massive reduction in building permits that are coming, if you're asking yourself, well, why are builders pulling back? And it's ultimately because it's a really hostile environment for them right now. And what that means is it's really hard as a developer, as a builder, to turn a profit when you're building homes right now. Keep in mind, today, approximately 30% of the cost of a new home goes to city fees and taxation. Pile on top of that, the 2 to 3 years of dealing with the city to get your development and building permits in place, which adds to the holding costs, right? You're not just holding a property for free. Even a vacant lot or a derelict house has costs every month. A quick story to share with you too. I recently helped a client buy into a half duplex on the west side. And one of the builders was there and speaking to the home and walking the owners through and pointing out all the great features of the home. And they mentioned that the duplex that they built is essentially unbuildable today. Because, of course, they bought that lot 3 years ago, and that lot is not the same price today. And the construction costs are up from 3 years ago. And so the price that they bought the home, it could not be rebuilt for that same price. They would guarantee a loss if they were to build that exact same property today. So that gives you an insight into, as a developer, it's very hard to come to market with all these fees and taxes that are thrown in here. There's very little incentive for a builder to enter this marketplace right now.
Yeah, I mean, ultimately, Dan, what you talked about is so interesting because, I think the intention of the tax is to, stifle these speculators. But when you're attacking 2% of the marketplace, it won't have a material effect on the marketplace. The other side of this too is we also have capital gains tax, which is a big part of this. Most people who would be flipping a home, it's not their primary residence. So they're also paying the capital gains tax on top of all those taxes you already stated. It continues to beg the question, these knee-jerk reactions to, like this new form of taxation is because we haven't asked the bigger question, which we've posed on our podcast before. How big do we intend Vancouver to be? How many people do we really want to bring here? What are we planning for? And does the housing policy fit that plan? I mean, you got to really think here. If somebody buys a house and then they go into it and they renovate it, and now they're going to get hit with a 20% tax, those people are going to not take their property to market. And if they further stifle supply, it's going to push price the other way. It's going to push it up. So again, you're going to push developers out because they're not going to want to deal with everything that they have to be confronted with. Consumers are also looking at this like, how can I get ahead? How can I take on a secondary, side hustle, maybe renovate a place and sell it for a profit so that I can get ahead and be less of a burden to the system? But here we are taxing all of this demand. And it boggles my mind why we keep banging our head against the wall, expecting a different result when we need to look the other side of the equation. That's just how I feel about this.
It's almost just that. Instead of tinkering and adding a little tax here and then a little incentive here and a little tax here and a more incentive here, it's just remove it all, essentially. Don't do either. Get rid of, this is essentially the solution in my book, or at least an idea here, is get rid of the majority, if you could. It's a hypothetical, of course, of the taxes and the fees. Yes, the city needs fees for infrastructure. I get that, but we're not saying maybe 30% isn't the right number. Right? So you pull back on the taxes, you pull back on the fees, obviously cut the wait times at City Hall. And one idea too is in incentivizing builders, is there a way to give them, I don't know, equate to like a tuition loan, right? Like a 0% financing on construction, or very low, 1%, keep it very meaningful and make it work for them. Essentially, we want to just stop taxing the demand and support the supply. That's my rallying call. Support the supply. Support the supply. You get the idea here. But we laugh, but that's what we need to see in place. We need to see builders incentivized.
And to speak to this, I mean, we've got another developer story where we're seeing the future inventory being stifled because of not only the uncertainty of the marketplace, but also the cost of building and having to contribute many of these, they're called CACs, community amenity contributions, to the city before any development can even take place. Developers have to put down millions and millions of dollars. And why would they expose themselves in a marketplace that the government keeps tinkering with? And it kind of brings me to the next story here. So the Vancouver Sun has recently reported that Anthem Properties was required as part of a rezoning of a 33-story, 127-unit apartment building on West Georgia Street. Granted, very expensive location, but they had to pay $26.1 million for their CACs, and this is to help offset the costs of to the city resulting from the project. Anthem has already paid more than $15 million of that total upfront, and the city has allowed the remaining $10.4 million to be deferred until the first permit building was given. Well, that was given 2 years ago. And Anthem is again citing now, they're asking for an extension on this additional $10.4 million because of market uncertainty from interest rates, the slowdown in the condo and market sales conditions, coupled with unprecedented increases in hard costs. Dan, going back to your point about the duplex builder who can't build the same product today, and it appears the city is looking like it will grant this extension because they're also facing the reality of what happens if we don't work with developers here. We're not going to get the housing supply that we need in the future. And this kind of goes back to the point. The things that move a market are access to liquidity and credit. That's what really moves the marketplace. And with restrictive levels of credit, interest rate uncertainties, coupled with higher construction costs, increasing CAC fees, and monumental density changes as a result of political policy, the incentive for developers to take on risk and build in this environment and not get hurt is just too high. So they're going to wait until the dust settles, until some of this stuff, they're going to hang back. They will let the market fall if it has to. Once there's a clear path, both from the market liquidity perspective and also from the regulatory change perspective, I think that's when we'll likely see developers really return to the marketplace and ramp up their building permits. But until that takes place, until there's some market certainty, until there's regulatory changes, kind of the dust settles, why would a developer take on this risk? There's just, the government keeps sticking their finger in, another tax here, regulatory change here. Some of it's good, but more taxes make it, confusing for people who are just trying to live here.
And it shows very much in our current inventory landscape. We've been talking about this sort of sub 10,000 marketplace for a couple of years now, and we're still there. It's February 29th today. We're recording this on a leap year day. And I just wanted to share a quick sort of market update. And as we have one extra day this year, I'm going to share the data up to the 28th. So we're talking apples to apples here compared to last year's February. So real quick, the sales are up as well this month, just like they were last month, to the tune of about 9% so far. Obviously, that bonus day will probably push that over 10%, but you get the idea. We're up about 9%. Just under 2,000 units are going to sell in February here. Inventory, if we take a snapshot right now, it's literally right at 10,000, but that will drop tomorrow because, of course, a lot of people pull off their listings at the end of the month. Some relist, some don't. We're going to wash out somewhere around, 93 to 9,500, but still sub 10,000 units yet again. Pricing, though, we're actually seeing pricing increase this month. Medians jumping about 22,000, averages up about 15,000. That will push HPI to maybe be flat because it is about a 2 to 3 month lagger. It might go down just a hair, but the rate of decline that we've seen for 6 months is slowing. Maybe an early indicator of near a cycle bottom. To be seen, of course, but that's kind of what we are tracking right now. Next week, of course, we will have the full February in-depth market outlook for you. Ryan, you want to take us home on this one?
Yeah, I'm just curious because maybe the last thing I'd like to touch on is maybe a bit of a prediction in terms of whether or not the Bank of Canada will actually cut rates in April, like some market predictors are suggesting. I'm still, I think, with leaning on the side of Doug Porter's prediction, where the bank will probably wait until June. With that said, I guess it really remains to be seen how employment numbers wash out, how inflation continues to wash out, and whether, other parts of the world, for example, I know, the UK, for example, has, formally announced they're in a recession. I think 3 of the 7 G7 nations are in formal technical recessions. So it'll be really interesting to see how that tends to affect our market here as well. So interesting times ahead, but until we start seeing more degradation in the environment and really specifically to jobs and employment, I think the Bank of Canada is going to wait until June before they actually do something.
Perfect. Thanks as always for tuning in. We hope you found this episode valuable. And if you did, please share it with at least one person that might get some value out of it too. Thanks again and have a great day. We'll see you here next week. Bye.